If you purchase a property with less than 20% down, you will probably need to pay PMI. Private mortgage insurance, or PMI, usually comes with a mortgage where you put less than 20% down on the purchase price. You don't have to have 20% down in order to get a mortgage. You can get a mortgage with as little as 3% down. However, most of the time, when you get a mortgage with less than 20% down, you will also have to commit to paying private mortgage insurance, or PMI, with each monthly mortgage payment. Because you didn't bring enough of a down payment when you purchased the property, the lender takes out an insurance policy that pays the lender if you default on the loan. They make you pay the premiums on that policy. If you can get out of paying PMI, you should try to get out of paying PMI. There is no benefit to PMI for you as the borrower. If you pay down enough of the mortgage to where your equity in the home, or the difference between its value and the current balance of the mortgage, is 20% or more, your lender might drop the PMI. That would reduce your payment and you wouldn't have to pay PMI anymore. If your lender won't drop PMI, then you can refinance the mortgage into one that doesn't have PMI. However, when you refinance a mortgage, you have to pay closing costs to the lender for all of the paperwork and transaction fees that go along with setting up a new mortgage. So you need to weigh the cost of refinancing the mortgage with the amount you'll save by not having to pay PMI anymore with the new refinanced mortgage.